Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Jan Nevruzi and Giles Gale. Before getting into today's discussion, I just wanted to remind you to hit the like button and don't forget to subscribe so you can get the latest episodes as soon as they're available. Okay, a big week of central bank speak this week. Well, central bank meetings rather, not central bank speak. So let's kick off with the Fed. We're recording this on Thursday, so just after the Bank of England and the Fed. But we'll go in chronological order and we'll start with the Fed. So Jan, what did we learn and what were the key takeaways from last night's Fed meeting?
We learned a lot. It was a highly anticipated meeting. A lot of wide possibilities of outcomes that we could have had, and we got something that fell on the more hawkish side of expectations. So let me start with what was widely expected. We got a 25 basis point increase in the interest rates. So liftoff has officially commenced. There wasn't a 50 basis point hike, which was pretty much expected going to the meeting, but the chair didn't really rule out a 50 basis point later on in the year. And that is key, we think, because if inflationary pressures maintain, they're likely to resort to one of those outsized hikes. And there was only one dissenter, St. Louis Fed's Jim Bullard, who wanted a 50 basis point hike at this meeting, even though he had previously mentioned that he would go along with what the chair says. He was also on record saying that he wants 100 bips in the bag by July. So for him to achieve that, he would need a higher increment. The real hawkish surprise, however, came from the so-called median dots. Every quarter, the FOMC members, they will send out their forecasts for interest rate expectations and additional economic forecasts, and the median of those get compiled into the dots. And the 2022 median forecast now shows 1.875%. And just as a reference, that was 0.375%, so 150 basis points higher than in December, which implies a 25 basis point hike at every single meeting until the end of the year. The 2023 median dot was increased to 2.75%, which shows another 3.5 hikes next year. And that's the same for 2024, while the long run estimate was brought down to 2.375 from 2.5, which pretty much says next year we're going to be in restrictive territory with interest rates. And it is an interesting point. We're not reading too much into why they lowered the long run estimate, but they're aware that there might be, some structural issues with tightening super fast. Well, at least maybe not super fast in historical context, but over the last decade or so, it seems really fast. In addition to the interest rate forecasts, like I mentioned, we got the economic projections, and they were also changed quite significantly, particularly for 2022. Particularly in the inflation side, the core PCE, which is the Fed's preferred gauge, was raised by 1.4 percentage points from 2.7 to 4.1. That's an incredibly huge jump for the near-term inflation expectations. We also share that concern, of course, given the tight labor markets, rising wages, high commodity prices, and we'll add to the list of inflationary pressures that are emerging every single day now. And also they decreased their GDP expectations by 1.2% for this year, from 4 to 2.8%. Again, another sharp drop, while unemployment was kept at 3.5%. And the reason I'm kind of digging into these forecasts is not so much that they always make these changes, but taking into account and keeping in mind that they show 7 hikes for this year and still have inflation that high is a quite dramatic shift in the economic outlook.
So taking all that together then, how does that leave our own, outlook for what we really expect policy to be for the rest of the year and beyond?
So for the rest of this year, we are now in line with the dots. We expect 6 more hikes for a total of 7 this year. We see 4 more into 2023 and 2 more into 2024. I'm talking about traditional 25 basis point hikes. Of course, 2024 seems so far away now, but we still assume that the economy will be able to hold and the Fed will be able to continue going into restrictive territory, which, if the economy does hold, suddenly the restrictive territory could become not so restrictive after they lift their long run estimate. So from today's perspective, we see that continuing. Our call was for QT to be announced in May. We didn't quite get the addendum at this meeting, but now we have a higher conviction that it will be announced in May, and alongside the addendum. For one, the chair said it will look very familiar to what we got last time. And remember in 2017, before they announced quantitative tightening, it was about 2 meetings where they released the so-called addendum, which had the details, how they plan to establish a cap on treasuries, on mortgage-based securities that they're willing to let run off from the balance sheet. And now they don't really have to give us that much notice because we've already been through that. The markets have been conditioned. They know exactly what to expect, which is going to be more or less the same statement, numbers almost multiplied by 2. And we're kicking off from June will be enough to say. They could have announced, I think, at the March meeting, but 2 reasons why I don't think they did. First, they have been very adamant that interest rate policy is their main method of influencing monetary policy. So they wouldn't want to do them at the same time. Liftoff, balance sheet normalization, more liftoffs. And second, they probably knew that the market was already going to tighten financial conditions just from the forecast that they would submit with the dots, and the market exactly did that. So they didn't need to add more pressure to that at this specific meeting. But next meeting, we have high conviction that we're going to get the balance sheet rundown plans.
And in terms of market impact then, I mean, yesterday we got, higher front-end rates as you would expect from a more hawkish than expected central bank meeting. But then further out the curve, at the long end, we saw a fairly significant flattening. And correct me if I'm wrong, but I think that long end yields finished the day lower than they started. So how are we thinking about, I guess, the outright direction of travel of say 10-year yields from here, but also the shape of the curve?
All right, so going to the meeting, we had a short August Fed funds contract that's kind of like a core view in anticipation of a hawkish FOMC, increased the odds of a 50 basis point being signaled over the next or the subsequent meetings, not this one. The trade has performed well, and we're still sticking to it. Given the balance of risks, we think everything has shifted to a higher likelihood of 50 basis points as opposed to not 50 basis points. So we could see market pricing it in. Whether we get that delivered is a different issue, but we should see more of those pressures if we're right in our assessment. As from flatteners, yes, structurally they still make sense, but forwards are already pointing towards decent levels of inversion, not so far in the future. If you look at things like 2s, 5s, and 6 months forwards, they're already inverted close to 8 basis points was this morning. So our conviction there is much lower, whether the curve will flatten as a function of rates rolling down, but I don't know if we'll be able to beat the forwards. They could, just the risk reward doesn't seem that attractive anymore. But I'm talking about things like 2s, 10s, 5s, 30s, where the front end is really, the front end will do a lot of the heavy lifting, and it's hard to say what will happen with the back end of the curve. And similarly, being short duration is aligned with our view for the Fed, and also aligned with our view on the economy. But I think what we're going to see now is a little bit of front loading of our estimates. So we had a view of like the short belly view. Now that might kind of shift a little bit to the front end of the curve as the Fed decides to react a little bit more aggressively, because there are scenarios where the Fed sees more pressure coming up. The Ukraine crisis is not helping. The new set of lockdowns in China are not helping inflation. There's going to be more supply chain pressures. We could argue if it's a demand or supply driven, but it's hard to say that there are no supply chain driven pressures still. So they might have the urgency to react. And I just cannot discard a scenario where they do something like 50-50-50 June, like June, July, and after that too. So I think it falls in September. But and then they slow down again. So if they do something like that, obviously the very front end of the curve will take the hit, and we could even start pricing kind of like a recessionary type inversions. Of course, an inversion itself doesn't lead to a recession, but that's what the market would do, just questioning, can the economy hold it? And if they can, it's not a discussion for today, but later on the year, we could be discussing kind of like the rare bear steepener if the economy manages to hold on to a kind of like a restrictive Fed. So, but let's leave that for the second half of the year. For now, we stick to short duration views, kind of like increased probability of 50 basis point hike. So kind of remaining short in the August Fed funds, and we're going to scale our shorts more into like twos.
Great, that makes sense. Thanks, Jan.
Right. Okay. So this is a great day for Bondcast listeners who really like listening to Imogen, because what we're going to do now is turn this around on the presenter and get her to talk about the Bank of England, because that was the other big one this week, and Imogen's been watching it very carefully. So I guess markets were expecting some probability of a 50 basis point hike. That did not happen. Maybe you can just talk us through a little bit the decision.
Yeah, like you say, markets were positioned for at least some chance of a 50 basis point hike at this meeting, although I really think 25 was probably the strong consensus. But it did feel like in the run up to the meeting that risks were skewed to the hawkish side in terms of the votes. And what we actually had delivered was, well, A, the 25, not the 50 basis point hike, but B, a slightly more dovish vote, in that the only dissenting vote was by Cunliffe in favour of keeping rates at 50 basis points rather than raising them to 75 basis points. Now, I guess he's viewed as one of the more dovish members of the MPC, but probably also quite consensual, and therefore the fact that he is, opting to keep rates on hold this time is probably indicative of the fact that the Bank of England may be thinking about this more hawkishly at the moment, and certainly, more cautiously, not more hawkishly, and certainly more cautiously than the ECB and the Fed appear to be. There was another slightly dovish element in the monetary policy statement, in that they changed the language around what more tightening might be needed versus the Fed meeting. So in February, they said monetary policy tightening likely to be appropriate in the coming months, whereas at this meeting they said may be appropriate in the coming months. So they've just kind of lightened up, I suppose, on how much more tightening we might expect for the rest of the year.
Okay, and so thinking about the rest of the year then, how do you think that this sets us up? What do you think the market profile, how does that look like compared to with what you're thinking?
Yeah, well, this meeting didn't really change our assessment, I suppose, which is in line with the Bank of England's thinking as well from the last monetary policy report, that rates would probably need to rise to around 1 or 1.25% this year to kind of reach their inflation target over the forecast horizon. So we still have another 25 basis point hike penciled in for the May meeting, and then an additional one in the August meeting. I think probably as we get closer to that kind of 1% or 1.25%, then the Bank of England may kind of approach those additional hikes with more caution, and perhaps might use I guess the justification of monetary policy reports to recalibrate policy at those meetings. So therefore we think a hike in May, and then potentially a pause in June before an additional hike in August, which would take them to 1.25%. As for how that compares with market pricing, I mean, we've had a fairly significant repricing today after the meeting, probably around, as we're recording, around 15 basis points of hikes have been priced out by August. But given how hawkishly the market was priced then, I still think there's further to go. Since I left the desk to record this, markets still had 3 full 25 basis point hikes priced in by August. And we think there's really only likely to be 2 more. So there's a good kind of 25 basis points of upside just out till August. And then the market had an additional hike at least priced in beyond that. So although we have seen some repricing of the front end, I think there's still quite a lot further to go.
Okay, right. So outside of the Bank of England, next week we have the budget statement, and now you've been thinking about what that might mean for the remit. I mean, it looks like there are lots of calls for big drop in gilt issuance. What are you thinking?
Yeah, well, I think really the main takeaway for markets from our perspective is just that drop might not be as big as expected. The borrowing since the October budget has come in much lower than expected. So essentially the DMO are kind of overfunded by about 30 billion in gilts because they haven't adjusted the remit for those lower borrowing numbers since October. But actually, with inflation being significantly higher than it was, and there's still very high uncertainty around that inflation outlook, I think that we can get additional costs in terms of debt servicing, but also, I guess, financial transfers to try and limit the kind of pass-through of that high cost of living, and also rise in public sector wages as well. So actually, I think the drop in the central government net cash requirement, which is the number that we use to form the basis of gilt issuance for the year ahead, won't be as big as markets are expecting. We penciled that in to be about 100 billion, whereas in the October budget it was just 107 billion. So yes, there will be less gilts next year. We pencil in a step down of about 37 billion, but that's just not as big as you might have expected just looking at the October budget.
All right, so let me press you for a bottom line on what you think this means for long-term rates in the UK. We've already talked quite a bit about the front end.
Yeah, I mean, our view is that long-term rates in the UK should continue to rise. I think the kind of dovish reaction today at the long end of the curve is a bit of a fade, and actually we should continue to see higher gilt yields in this kind of globally rising rate environment, where we have a year-end target now of 1.8% on 10-year gilts, and obviously the kind of less than expected drop down in supply numbers next week should add to those bearish pressures. That said, I do think that gilts can outperform on a cross-market basis, particularly versus Europe. They've been underperforming of late, and I think that the supply picture in particular, once you net off, I guess, APF or the no APF purchases in the UK and Eurosystem purchases in Europe, that kind of delta between last year and this year is much more negative for European fixed income than it is for the long end of the UK curve.
Okay, I'm just going to interject there very, very quickly. I'm sure that listeners all realize this, but the APF is what we call quantitative easing, basically, in the UK.
Yeah, thank you. That's true.
One small point of jargon. Okay.
That's true. Sorry, I forgot that. And with that, I guess that gives me the perfect segue to pass back to you, Giles, then on what we're thinking about Europe, because we obviously had the ECB meeting last week, which was much more hawkish than expected. We did catch up on Bondcast after that meeting. But since then, we've also had the ECB Watchers Conference, which is going on today. It's still ongoing, but is there anything that we've learned from the speakers this morning, I guess, Lagarde and Lane, most importantly, that I guess adds to what we heard from last week?
Well, I think the short answer is not a lot, no. I mean, there was some, discussion, I suppose. I mean, you can always draw out the things that you want to emphasize from what is a whole day of discussion. No, I mean, I would just go back to this change in the forward guidance, where what does sometime mean, where that is the phrase that's used to link this end for quantitative easing to the start of rate hikes. And I think the emphasis there was, as we discussed last week, and unsurprisingly, in my opinion, nonetheless, not necessarily the way that everybody chose to interpret it at the time, that is really trying to open up flexibility to take longer rather than less time to raise rates. And so, I think overall, and just generally, there seemed to be a little bit more emphasis on the downside risks overall. And so, I take away from that a little bit more confidence. I mean, we already have pretty high confidence, to be honest with you, but certainly it seems like our high level of confidence is tracking well through all of this, that the ECB will not be as aggressive as the market is expecting in terms of rate hikes for this year. And I say that knowing that at the same time we had Arch Hawk Klaas not talking about, well, pointedly refusing to rule out 2 rate hikes for this year, but 2 rate hikes is essentially what the market has been pricing in. So yeah, I think that is really what, I mean, that's your hurdle, and I think the skew of risks is very much in favor of being long that very front end. So yeah, I mean, I suppose that those are my main 2 takeaways.
What about further out the curve then? I guess, the main announcement at last week's ECB meeting was that the taper would be much faster this year than we were expecting. And I kind of alluded to it in what I was saying around this kind of supply picture net of Eurosystem purchases. But with the ECB stepping away, in any case, our baseline was for a pretty much unchanged supply picture this year. But I guess risks to that are now to the upside, given that there may need to be some fiscal support with the latest Ukraine crisis. So how are you thinking, I guess, about the demand and supply picture of European government bonds for the rest of this year? And who do you expect to step in to really plug the gap that the ECB will be leaving behind?
Well, this is the fundamental question of the day, of course. And I think that there is a view out there that supply just doesn't matter. And therefore, quantitative easing, in a sense, sort of doesn't matter. It's all about the signaling impact. And so people go back and they look at what happened in previous cycles with the Fed and the Bank of England. And it is very difficult to really establish any kind of clear link between the end of quantitative easing and any rise in interest rates. More often than not, in fact, you see the opposite. I don't think that that's what we're going to see in Europe. I think that in Europe, quantitative easing was a much bigger deal. It's been going on for longer, amongst other things. It gets into a lot of areas where, to be honest with you, I think you might question. In the UK, the US, it's a little bit more questionable. So, and no, I mean the swing in terms of where we were last year, massive deficit in terms of total bonds coming into the market, to actually quite a big surplus is really very big. It's I mean, at the most kind of optimistic, depending on your perspective. I mean, the sort of most bond bullish, if you like, rates bullish anyway. We're talking about $500 billion, 500 billion more bonds coming and being made available sort of to private or not being taken away from the private sector. And it could well be on the upside. I mean, you've just been talking about the UK public finances, for many of the same reasons. And I think that the risks are clearly that there will be a need for more funding rather than less over the course of this year. So we could easily be talking about 600 or 700 billion of bonds. And that is by far the biggest shift in the supply panorama in the last sort of 7 years since quantitative easing began in Europe. And it comes at a time when it's not obvious at all that the fundamentals are conducive to just clearing that. I mean, with high inflation and central banks sort of looking a little bit more hawkish in general, it's not clear that people are going to want to rush in to fill that gap. And so as you look around the various big holding sectors, I mean, we know who they are: they're banks, they're pension funds, they're insurers, they're funds, the foreign sector. There's no big story here that you'd say, okay, something's happening here that these guys really need more bonds because they've got they're short on liquidity, or there's a regulatory story wherever it is, or there's a solvency story or something like that might kind of drive gains in equities back into bond. You don't have that anywhere. So the only thing that you could that I can really see that pushes that drives the market back towards equilibrium is the price mechanism. So we're going to need, in my opinion, still a pretty big concession, and so that is really my bottom line here. I think that I mean, some people, I mean, it was quite a popular trade to be short last year on the back of the changing inflation dynamic and so on. Wasn't ever really validated by central banks. This year it will be, okay. And I think that it's been slow to develop, but it's starting to develop, and I think it's got quite a long way to go. So that's that. Higher rates, they're coming.
Okay, so perhaps we can just contextualize higher rates then for our listeners. You know, regular listeners will know that we've had a long held target on 10-year bond yields of positive 0.5%. We've had some pretty big moves in rates, so, well, really over the last couple of weeks, but we're now only sort of 10 basis points away from that target. So I guess, how are you thinking about 10-year bond yields from here? Further, do you think they can go through that 0.5%, or is that a kind of ceiling? You know, what would you be putting as your target for the next couple of months from here?
Yeah, it's a key question, and I allow myself to be flattered that our listeners are actually plural, and of course they all know, that we've been banging this bearish drum for a while, and we are getting close to that target. Listen, I think, given what I've just said, I think it probably will require us to look very closely at that target for this year, for everything, of course, but I mean, in particular, the one that we talk about the most, just because the market benchmark, the 10-year bond yield. I think we will be looking at that very closely. So I'm not going to make an announcement on that this time, Imogen, but maybe I will. Maybe we'll be ready to do that next week.
All right, there you go, listeners. A little teaser to come back for next week. On that note, we will end this week here. Thank you both for joining me again. And a reminder to our listeners that if they liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you again next week.